Today, we're going to deconstruct one of the most surprising corporate comebacks of the year. It's a real story of financial discipline set against, well, a backdrop of market chaos. We're talking about Top Glove, the world's largest manufacturer of rubber gloves. Now, if you followed the markets during the pandemic, you couldn't escape that name. They were right at the heart of that massive global demand surge. But wow, the years that followed were brutal as the industry faced a pretty painful correction. A lot of people thought the road back would be a long, slow grind. But then, Top Glove dropped its latest quarterly results, and the numbers are, to put it lightly, staggering. They suggest a major corner has been turned and way faster than anyone anticipated. So let's get into the data and figure out exactly what happened here.
Okay, let's dive right in. To really get a handle on just how big this story is, we have to start with the one headline number that made everyone sit up and pay attention. It's the kind of figure that makes you stop, reread the report, and double-check the math because it just seems almost too good to be true after the tough environment they've been in.
That's right, 680%. In the first quarter of their 2026 fiscal year, Top Glove's profit shot up by 680% compared to the same time last year. That brought them to a profit of 39 million Malaysian ringgit. Now, let's be clear, 39 million isn't a huge number compared to the billions they were making at their peak, not even close. But that's not the point here. The point is the direction and the speed of this change. After a period of pretty significant losses, this isn't just a small step back into the black, it's a massive leap. It signals that the engine of their turnaround strategy is firing on all cylinders.
So, this brings us to the big question, right? How? How on earth did they manage such a dramatic turnaround? I mean, the post-pandemic world for glove makers has been incredibly difficult. You had this massive oversupply. Prices were plummeting and competition was just intense. Customers who had stockpiled gloves were just using what they had, not placing new orders. So against that backdrop, a 680% profit surge just seems to defy gravity. The answer, as we're about to see, isn't a simple story of sales just booming again. It's a lot more nuanced and honestly a lot more impressive.
Okay, so to really understand this profit surge, we first have to unpack their sales figures. Because there's this fascinating little puzzle hiding in plain sight. It's like something straight out of a business school textbook, but it's playing out in real time. And solving this puzzle is really the key to understanding the entire turnaround story.
Now check this out, because this is where it gets really interesting. Look at the bar on the left. Their sales volume, so the actual number of gloves they shipped out the door, jumped by a very healthy 17%. In any normal business, a 17% jump in volume is fantastic news. It means the market's recovering, you're grabbing market share, things are good. But now look at the bar right next to it. Their total revenue, the actual cash they brought in from selling all those gloves, barely moved. It was pretty much flat. So how in the world can you sell 17% more stuff but make the same amount of money? That's the central puzzle we need to solve.
And here's the solution to that riddle. On one hand, you've got some really good news. Demand is finally starting to get back to normal. Customers, especially in big markets like the US, have finally worked through all their extra inventory and are starting to order again. That's what's driving that 17% volume growth. But that positive force was hit by an equally powerful negative one. The price Top Glove could charge for each and every glove was lower than it was a year ago. So these two forces, selling way more gloves, but for less money each, basically canceled each other out. And that's how you end up with flat revenue.
And this all comes down to a really important term, average selling prices, or ASPs. In the glove industry, a big driver of the price is how much the raw materials cost, like nitrile latex. As those costs came down from their crazy pandemic highs, manufacturers had a choice. They could keep their prices high and just pocket the difference as pure profit, or they could lower their prices. In a super competitive market, Top Glove chose to pass some of those savings on to its customers. This was a strategic move. See, lowering prices made them more competitive, helped them win back customers, and drove that 17% volume growth. The trade-off, though, was that it kept their revenue from growing along with it.
All right, so let's get to the next piece of the puzzle, because this is where the story gets really good. If revenue was flat, then that incredible 680% profit jump had to come from somewhere else, right? It couldn't have come from selling more or charging more. It had to come from inside the house. This turnaround wasn't driven by the market, it was driven by operations. It came from this disciplined, aggressive, all-out strategy to overhaul their own business, slash costs, and boost efficiency at every single turn.
And this slide, right here, it lays it all out. This wasn't just one magic fix, it was a multi-pronged attack on inefficiency. First, higher plant utilization. As they sold more gloves, they could run their factories closer to full capacity. This is so important. A factory running at 80% is way more profitable for each glove than one running at 50%,
because you're spreading your fixed costs, like rent and machinery, over way more products. That's economies of scale right there. At the same time, they were zeroed in on quality, cutting down on defects and waste. They rolled out strict cost optimization everywhere, probably looking at everything from the electric bill to office supplies. And finally, strategic organizational realignment, which basically means they restructured to become a leaner, meaner, more agile company.
And to really truly get how wild this turnaround is, you have to see it in context. It has been a total roller coaster. At the absolute peak of the pandemic in 2021, they posted a mind-boggling 7.8 billion ringgit profit. I mean, it was historic. But the crash was just as dramatic. Just 2 years later, in 2023, the market had completely flipped, and they were staring at a staggering loss of 886 million ringgit. So this climb back to a 39 million profit in this latest quarter, it's not about getting back to that 2021 peak. It's about pulling the company out of a complete nosedive and proving that their new, leaner way of doing business is fundamentally profitable, even in a tough market. It's a massive shift.
And hey, you don't have to take my word for it. The company's managing director, Mr. Lim Chung Guan, said it himself, and the language he uses here is very telling. He points directly to their unwavering focus that suggests a relentless, disciplined effort on optimizing quality and cost efficiency. He's making it crystal clear that this wasn't just some lucky break because the market got better. No, this was the direct result of their internal strategy. It's a confirmation that they won this battle not out in the market, but on the factory floor and in their own expense reports.
So they've stopped the bleeding. They've pulled off a successful turnaround in the short term by mastering their own operations. So now that we know how they did it, the big question is, what's next? Was this just a one-time success born from deep cost-cutting? Or is this the beginning of a new, sustainable era of profitability for the company?
Well, if you ask the company's leadership, they'll tell you it's definitely the start of something new. The executive chairman, Tan Sri Dr. Lim Wee-chai, frames this quarter not just as a single win, but as the creation of a strong, healthy foundation. Now that is very carefully chosen language for investors and for the market. It's meant to signal a shift away from that boom and bust volatility we saw around the pandemic and toward a future of more predictable, stable growth that's built on a rock-solid base of operational excellence.
And this is how they're planning to build on that foundation. They expect global demand to keep recovering as customers finally use up the last of their stockpiles. And here's the big one. They are now confident enough to start reactivating more of their production lines to meet that rising demand. That is a huge vote of confidence. It's expensive to restart idle factories, so you only do it if you're sure the orders are coming. At the same time, they're doubling down on the efficiency that got them here. And finally, they're actively managing financial risks, like currency fluctuations, which is just critical for a global company.
But, building a healthy foundation these days, it's about more than just the money. In today's world, big investors and corporate customers also demand a real commitment to sustainability and good governance. A company's reputation is built on more than just profit margins. Top Glove knows this, and they are actively trying to build their story around these key environmental, social, and governance, or ESG areas.
And they're not just talking the talk. They've got some serious achievements to back this up. Their ESG rating was just upgraded to AA by MSCI, which is a major ratings agency. This isn't a small thing. It puts them in the top 22% of their industry all over the world. They were also recognized by the United Nations Global Compact. Look, these are not just feel-good awards. For huge institutional investors who have rules about investing in sustainable companies, these ratings are crucial signals. They can actually lower the cost of borrowing money and open the door to new investors, which just reinforces that healthy foundation the chairman was talking about.
So let's wrap this all up. Top Glove has pulled off an incredibly impressive efficiency-driven comeback. They managed a 680% profit surge not by riding some wave of massive revenue growth, but by fundamentally transforming their own operations to become leaner and tougher. It's a true masterclass in cost control. But this brings us to our final question. In a highly competitive global market, one that's subject to all kinds of risks, geopolitics, supply chain problems, new competitors, is being super efficient enough to guarantee success in the long run? They've proven they can control what happens inside their own four walls. But the greatest challenges, they often come from the outside, and how they navigate those external pressures, well, that remains the billion-dollar question.